Hello, everyone. I'm Victor Kruger, and welcome to the MNP Spring 2024 Agricultural Industry Webinar. The war in the Ukraine unfortunately continues, and the war in the Middle East has not abated. John will outline how these and other local and international issues affect the Canadian and the world agricultural industry. I'm a Senior Vice President of MNP Ltd., the insolvency and restructuring arm of MNP LLP. MNP LLP is one of Canada's largest professional services firm with specialized client service groups that we call niches, each with dedicated employees working in them. This allows us to provide our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches. Agriculture is our largest and oldest niche, dating back to 1958 when the firm was established. As the agriculture niche is so large, it is further broken down to sub-niches, including food and manufacturing, intensive livestock, primary producers, hydrites, cannabis, and farm income programs. MNP is also the only professional service firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agricultural farming backgrounds and bring a high level of technical expertise, first-hand knowledge, and close relationships with the agriculture industry to give us a real understanding of the issues faced by today's agriculture industry. The FMC group also supports all of our other service lines in any ag-related engagement, and in particular in every agriculture insolvency or restructuring where they provide us with expert advice to a specific situation and, if necessary, to be hands-on in a formal engagement. John Loeppky of our Winnipeg office and part of our farm management consulting group will again provide his insights into Canada's ag industry. John is a professional agrologist who has over 20 years providing services to the agriculture industry, starting as an ag lender and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as needed. Our webinar has been pre-recorded to allow you to watch it on your time. At the end of the presentation, you'll find contact information for both John and myself for any of your questions. We will respond to them as quickly as we can with hopefully the answers you require. John, the floor is yours.
Thanks, Victor. So to start off today, I'll just kind of outline where we're going to go and what we're going to talk about. Yeah, table of contents is up there. We're going to look at, just some general market fundamentals, some trade issues that we're facing today in Canada, and then run through some of the major commodity groups for Canada and kind of what's going on in each of them and highlight some issues or positives that are happening in each. So. I always want to start off with, just reminding everyone that, especially when it comes to agriculture, there's some major influences that impact farms across the country. Mainly supply demand issues, trade and supply management. So, farmers are obviously on the supply side of the equation there. And we always say that supply is usually quick to change. While demand usually stays a bit more steady. And a lot of the commodities that Canadian farmers are producing are obviously sold around the world and exported to all sorts of different locations. So we definitely want to look at things on a local scale, but also on a global scale, as those what's happening around the world really impacts us from day to day. And that kind of leads into that trade topic. Canada has lots of different trade agreements with different countries around the world, to allow, our product to get into all sorts of different markets, and also reciprocal, so that some of their products can come into ours. So really also again highlights, that we're again competing on that world scale, world stage. And probably another thing just to comment here is, when we look at things on that large of a scale, what we really see as a high level trend or a long-term trend is production tends to move to the lowest cost of production areas, right? And that'll be net of transportation and all the things it takes to get that commodity landed in someone's backyard. But definitely that is the overriding trend that we see is lowest cost of production does tend to win in the long run anyways. So now, I guess the other thing we want to highlight is supply management, a little bit unique to Canada, in that, our dairy and our feather industry is under a supply management protocol. So, we definitely see though that, and as you'll see in some of our ongoing slides here, is that even those protected industries are also impacted by some of our trade agreements. So given, that we just chatted about, global trade and the fact that, Canadian product is lining up all over the world, thought it'd be good just to highlight some of the exchange rates that we're seeing over the last 12 months and longer. The red there is the USD, and probably, for Canadians, that's a probably important one in that we sell a lot of our agriculture products. And obviously to the U.S., they are our biggest trading partner when it comes to agriculture. And so prices are always set in Canada, but based off of whatever that U.S. price is, and converted back to Canadian funds. So just as you can see that trend, we've kind of bumped along the road for the last 14 months ish, and that exchange rate's kind of back really close to where we started. So just something to keep in mind as we go along, that even though we might be seeing some prices jump around, we always have to be mindful that some of that might be just due to the exchange rate changes, and not necessarily some underlying commodity pricing. So. And of course, one that impacts probably most farmers is interest rates, and I'm sure we'll be talking about this for a while. But just wanted again to highlight that, interest rates are still at a higher level than what farmers have experienced for quite a while. And I think a lot of what we've chatted about maybe in previous sessions as well is that, Canadian farms for the last 10 years have kind of been built on low interest rates. And now we're seeing some of those cracks starting to form on certain farms that maybe over leveraged themselves, took advantage of some lower interest rates, and maybe did their modeling thinking that those low interest rates were going to continue. So as we go through the commodities, I'll kind of try and highlight which ones were probably impacted a bit more than others. But obviously, I think all the producers across Canada are probably hoping for some lower interest rates, and we're starting to hear maybe some talk of that from Bank of Canada, at least on the floating rates here. So remains to be seen, I guess. But it is the environment that we're working in today, and definitely as I mentioned, we're starting to see some of the cracks forming in certain farms that maybe over leveraged a bit. So maybe we'll highlight some of the the trade or some of the world events that are happening or that are impacting Canadian farmers right here at home. Victor mentioned the Ukraine conflict that's ongoing. We definitely see that wars are usually long and prolonged and drawn out, and this one appears to be the same. So really, I think the major thing that's impacting Canadian farmers is just we're seeing more volatility in some of the commodities that their farms are selling, and also maybe some volatility in some of the inputs like fertilizer that they're buying on their farms. So I'd say the volatility is probably getting a little bit less as some of those supply chains and trade routes get a little bit more stabilized. But definitely every time we hear some news coming out of Ukraine and Russia, we are seeing that impact pricing of some commodities to a certain extent. So, another thing to note is this Canadian-India conflict, maybe a little bit more regionalized in that it really affects probably lentils more than anything else. So maybe more Saskatchewan in the west here than some other areas of Canada. But definitely that, it seems like there's more strained relationships as a result of, that assassination of Canadian Sikh within Canada. So definitely those relationships are strained, and we're starting to see maybe a little bit of concern, obviously, on the lentil front. So just something to keep in mind. And I guess an update on Bill C-234. We kind of chatted about this one in the fall, that it was moving to the Senate, and we thought it was going to be probably done by now, but the Senate amended that bill to remove the exemption for buildings. Again, this is the carbon tax on propane and natural gas used for on-farm heating of barns and other buildings. So we're kind of in that delay status here where it went back to Parliament for further debate before it kind of heads back to Senate. So just keep an eye on that one as we kind of move forward. And I mentioned, even supply management is impacted by trade nationally and internationally. So, here's maybe a little update on the dairy side. We've had two major trade deals, CPTPP and CUSMA, that both had dairy as part of them. And what we're seeing is that, those deals were negotiated, and now those partners are coming back saying, well, Canada, you negotiated this way, but you're not actually living up to it. So then they're coming back and disputing how those trade deals are actually being allocated out to their producers that want to import product into Canada. So I guess the interesting thing here is that, dairy producers in Canada have already been compensated for CPTPP and are starting to get compensation for CUSMA. But it looks like when you look at what the disputes are, it seems that the impact hasn't really been felt yet. So even though the dairy producers are getting compensated for giving up market share, it certainly appears as though that market share isn't actually being given up just yet. So, and I guess at the bottom there, yeah, there was a trade deal with UK and Canada that kind of fell through earlier this year, just to some sticking points such as the dairy industry, right? And some of those cheese imports with the UK. So moving on to the poultry side, we'll kind of give you a quick update on what's happening in this industry. So, high level, the avian influenza kind of continues. Obviously not a great disease that any producer wants to get, but seems to be continuing, although at a bit of a lower level. I think we're going to see some moderate growth in this industry as far as margins, and I think as far as demand as well as we go into 24. But we are seeing, it's pretty challenging for new entrants to enter the poultry industry, largely impacted obviously by interest rates. As a new entrant, you're coming in really highly leveraged, lots of debt usually. So you're really sensitive to changes in interest rates. And we definitely have seen that even though new entrants are being allocated, free quota, that might not necessarily be enough to make them viable as we go forward. So interesting, just that when we look at it, even those new entrants probably have to have some sort of off-farm income in order to support their new poultry business for the first couple of years anyways. So a little further into the AI, it seems to have stabilized in most Canadian provinces. Currently as we're kind of preparing this, you can see kind of those infected premises across Canada, which, has been going down over time. And we're definitely seeing that there's a vaccine for ducks now that's going to be administered. And I think the idea then is obviously, hopefully they can adapt that vaccine to more commercial operations here in Canada for not only ducks, but obviously for chickens and turkey and whatnot. And I think demand is pretty steady. And we've started to see some increases in 22, 23, and I think that trend is going to kind of continue. As I mentioned, there's some news already that poultry prices are expected to increase. If on about 10 cents a kg, and another 10 cents a dozen for the egg side in 24 here. I think we're seeing some quota being allocated as well later on in the year, which indicates obviously that demand is coming through. So, and again, we'll talk about it more once we get to the grain side, but definitely we're seeing feed costs come down. So for any livestock producer, that's a good news story. And so I think that's going to add some more margin to these farms as we go forward in 24. So I think outlook looks pretty good for existing producers in the poultry side, as we're seeing some pricing increases, some expectations of some lower feed costs, which should all add to a better margin when we're going to look at 24. Moving on to dairy, I think the story is a little more mixed on the dairy side. I've got their moderate profitability, but I think it's probably a regional story is maybe a good way to put it. There's definitely parts of the country that are experiencing some of that moderate profitability. I think there's also other parts of the country, BC in particular, that's really struggling right now. So, we talk about cost of production at the beginning there and how important that is. And definitely we're seeing that on the dairy side where those producers that are at that higher end of that cost of production are having a really hard time managing in the industry. And like I said, part of the higher cost could be interest related. And so we're starting to see some of those cracks form, and definitely seeing some struggles on definitely some farms. As we look across Canada, there's that strain in BC. I think there's also been maybe some feed issues in some of the Western provinces, getting better, I think, than they have been. But we'll take a look, I guess, at a few specific things here. One other thing to note, I guess, though, is that, with that higher cost of production that producers are feeling, there is a process in place to obviously adjust the milk price based on their cost of production. The decision was made this fall that they were going to delay that price increase of 1.8% to May. Normally it happens in February. And part of that was due to the fact that the federal government was bringing grocers, I think, to task, if you want to call it that. And so the industry felt that it would be bad form to be announcing that price increase at the same time that grocers were kind of under the gun. So if we kind of look at, a little bit deeper here, you can see that we're looking at lower butter stocks right now for the dairy side. So the graph kind of shows you where we've been in the last year, and definitely throughout the whole year, we've kind of been on that lower end. So, and the butter stocks are kind of the buffer that the industry has for what, demand increasing or going down, right? So we're definitely seeing we're at the lower end of that. So if demand also does surge, then there's going to be a big push for increasing the butter stock. So, and we did see some incentive days announced, one in the P5, less than last year. And we're expecting that there could be some some more coming for the east and also the west later this year. Again, kind of based on as demand plays out and how consumers are feeling. So as I mentioned, grain prices have started to slide off the highs of 21 and 22. I think we saw 23 starting off strong on the pricing side for crops, but have definitely softened as the year went on. And I think as we go into 24, we're expecting maybe that to continue. So I'd say again, I think I mentioned it last time, given that we had some record margins, record profitability in this sector recently, we definitely saw that farms took advantage of that and started either growing their land base or also just redeploying all that capital out there. And I'd expect that we're probably going to see some issues where some producers maybe bought too much equipment or probably looked at buying some really expensive land, and some of those decisions might not turn out to be great ones, depending on how the pricing and the production side, I guess, works out here in 24. So again, just a reminder that the hardest time sometimes as a producer to decide what to do is actually in those good years when you've got lots of working capital, profitability is up there. It's really tempting just to make some decisions that maybe are not long term and a little more short term, and those definitely land up impacting you on the longer side of things. So, but let's get into the actual production outlook. So we're going to talk about U.S. first. As I mentioned, big trading partner with Canada, and obviously lots of the pricing is set based on how the U.S. Crops go, because their size is just that much bigger than Canada. They do actually sway the market a little bit based on their production, whereas Canada, we really don't sway the market at all from that side. That being said, we can have a bumper crop and it's really not going to affect pricing on a world market. So we look at kind of those two major ones that the U.S. grows, corn and soybeans. USDA always comes out with their forecast every year, so you can see that up there. And so really what it's showing is they're expecting that we're going to see acres switch out of corn and into beans. So that kind of means, maybe a few things. It means that farmer sentiment is they think the margins are better in beans for several reasons. And so they're going to be switching acres over there. So overall, I think the expectation is, though, that production per acre is going to be up on the corn side from 181, which is up from 177 the year before. And same on the soybean side, we're going to see, kind of that 2 bushel an acre increase or 1.4 is kind of what they're expecting. But I'd say for both of them, if you look at the pricing that we have in there, that's going to be probably significantly lower than what we were looking at this time last year. So even though we might be seeing the estimates for production per acre going up, I think revenue per acre is likely going to be down from where we saw it last year. And moving a little bit closer to home, here's kind of what the expectation is for planting in Canada here. Relatively the same for soybeans, a slight uptick maybe in that estimated yield. I think we're going to see more acres moving over to canola this year, with, again, a slight uptick in expected bushels per acre. The note there is obviously some areas in the prairie are facing that moderate to maybe more extreme drought in certain parts of southwest Saskatchewan. Again, depending on how this year plays out, but that's what we're seeing right now. And then again, a little bit of an uptake in acres for wheat, and the bushels per acre going up as well. And same as the U.S., our pricing is all set in U.S. dollars. So we're going to follow that same trend as the U.S. side. So where we're seeing for lots of our grain commodities, those pricing coming down off of some historic highs from what we've seen. So, and we do like to talk a bit about machinery purchases. You know, we always say that that's a bit of farmer sentiment. You know, if their outlook is pretty strong, we see equipment sales go up. If they're starting to get a little more bearish, then we definitely see these equipment sales starting to slow down. So, you know, I think we are seeing sales slowing, as you can see there, for the most part, and probably a combination of grain prices coming down, but also I think equipment prices are also have increased significantly. You know, we're looking at large four-wheel drive tractors costing $1 million, and you know, a combine with all the headers and everything, 1.2, 1.3 million. So definitely some major decisions that farmers are facing if they're looking at buying new equipment going forward on maybe some grain prices that are a lot softer than what they've seen over the last couple of years. And FCC came out with kind of their land values and what the trends were in 2023. As you can see, you know, as a whole, Canada went up 11.5%, and up everywhere, I guess, except for BC, which is that anomaly where we did see it actually come down. So, you know, I guess it's adds to the net worth when we see you know, these types of numbers coming out. Lending values are a little strengthened, I guess, as a result. But I think for the most part, it's fairly safe to say that farmers in Canada these days, when it comes to lending, typically security isn't the issue. Typically, the farms run out of cash flow long before they ever run out of security to secure a loan. So, but good news in the long run that there's still strong demand for land, I guess. Saskatchewan in particular, we saw a big increase there, 15.7%. So, so again, it goes back to the fact that farmers are definitely in the long term seeing some positive outlooks for the industries that they're in, and are looking to continue to buy land. Moving on to hogs, you know, I think we're seeing a little bit more optimism in the industry in 24. 23 was definitely a really rough year, and we saw lots of impacts from that with you know, plant closures in Canada and the US, some major players shuttering barns across the West. The margins really were quite low last year, but we're starting to see margins, at least the outlook is improving as we go forward this year. And I think a large part of that is, again, because we're seeing softer feed prices. So I think we do expect to see that there is some opportunity to capture some higher hog prices as we look forward. But the major driver is likely going to be on the feed side. That's going to drive profitability. So the other piece, I guess, just to mention is that, you know, we're seeing demand in China is expecting to drop a bit due to population decline. That being said, they really have ramped up their production lately. So I don't know if we're necessarily going to see a whole lot of change coming out of that Chinese market. So, and you know, we kind of run a little bit of a forecast on what we here in Manitoba would see, kind of some fair to finish margins. And definitely you can see that production expenses per hog line is coming down off some highs. Obviously still up there when we look at the 5-year trend, but starting to see, you know, on a per head basis, some gross margin maybe showing back up. So, so I think it's definitely a time for producers to, you know, rebuild some working capital, and get those balance sheets a bit healthier this year, because they probably took a bit of a beating last year. Moving on to cattle, you know, I think on the pricing side, we're definitely seeing a pretty strong outlook overall for the sector. There's lower inventories in the industry. There's obviously some drought challenges in the US. and certain parts of Canada here as well. So definitely, I think we're seeing that the pricing side of things is really strong on the cattle side. I think cow-calf guys have a pretty good outlook for this year going forward. And I think the industry would like to, probably expand, but probably being hampered by the lack of feed in Canada and the US. So, yeah, I think we're seeing some record high prices in this sector. So, definitely a good time for guys to capture some margin. Again, we're seeing the market's been pretty strong on this one for a few years, but definitely ability to rebuild some working capital because it is very cyclical, and we could see that downturn coming as well. Yeah, and as I kind of stated, probably no expansion in the North American beef herd. Just feed supplies are pretty tight on the grass and the hay side. We're seeing feed prices kind of softening, but record high calf prices, which is good for the cow-calf guys. So there is some drought assistance for Saskatchewan and Alberta that was announced. Also, around Southwest Winnipeg, there was some tax deferrals that were available. So, anyways, as mentioned, there's always that cyclical high summer demand. We'll see if it gets sustained going forward. Higher interest rates, inflation on some food, as we'll talk about later on, might be what kind of curbs the market, right? Consumers are only going to pay so much for beef before they switch out to a different protein. Moving over to wineries, I think the biggest news that we're seeing obviously is BC Interior there had a very severe frost this year, and that's resulted in some major devastation. And the industry is really reeling from that. Between that, some major fires that have gone through the region recently. I think the industry is kind of not doing great in that part of the country. As a result, BC announced there's 70 million for replanting after that devastating crop loss. I think that program opens up here in the early part of April. So definitely there's some assistance, for producers, but obviously not a good news story, because you're obviously losing production as a result of that frost coming through. So, yeah, we're also seeing, sales coming off of maybe some of those pandemic high levels, and then the federal alcohol taxes increasing by 2% on April 1st. So, lower than expected. So that's, I guess, good news in that it's lower than what the industry was kind of forecasting. Looking at cannabis, I think the industry revenue as a whole has grown in the last 5 years. I know there's definitely been struggles in the industry as they've gone through a lot of change and a lot of consolidation and figuring out how much the market's willing to bear. But we are seeing signs that the Ontario cannabis market is reporting growth. And I guess the only thing other to mention there is, there's a regulatory fee increase coming in April 1st. So I guess a bit of a tax for those producers that probably is going to get passed on to consumers, but definitely we're seeing that coming in soon here. And here's just kind of that fee schedule that we're going to see adjusted, like I said, April 1. And moving on to food and beverage, I think there's been lots in the news recently about food inflation, and definitely something on the top of mind for lots of consumers is that rising price of groceries and how it's impacting their overall budgets. So, we'll say that it does seem to be slowing down and narrowing in on overall inflation. So we are seeing that slowing down that rate of change, but that doesn't mean that the prices aren't high and people are adjusting to it. And I think what we're seeing is is consumers are just choosing different products, right? So as a result, like I said, there's budgetary constraints at the household level potentially, so consumers are choosing different products, and those seems to be those products are lower margin products for the most part. So so in general, we're seeing margins kind of getting squeezed as consumers are just choosing a different line of products. So you know, the federal government had promised those price freezes as I mentioned previously, but really we haven't seen grocers commit to anything. And there doesn't seem to be a real solid plan or follow-up from some of the planning that was done back in the fall. So, and yeah, so just kind of showing the consumer price index for food purchased from stores, and that 12-month percentage change and how it's index for food from stores and then that all item index as well. So definitely seeing the pattern is the same, but that change is definitely different between those two. But definitely, as I mentioned, that gap is narrowing as we go forward here. And that takes me to the end here, and I'll turn it back over to Victor.
Thank you, John. Another very informative session. We would like to thank everyone for participating in this webinar and would encourage you to contact John or any of our other FMC practitioners directly with any specific agriculture questions you may have. Any insolvency related questions should be directed to me or any of our cross Canada insolvency team. The appendix to today's presentation includes further information about MNP, our farm management consulting group, and our corporate restructuring practice. This webinar link has been sent to all of you as you had previously requested to be added to our Ag webinar distribution list, and will also be posted to our mnpdebt.ca website. Please feel free to forward the link to your colleagues and encourage them to contact me directly should they wish to be added to the distribution list for future webinars. We also look forward to your participation at our fall 2024 webinar and also look forward to any questions or comments you may have regarding this presentation. Thank you for listening and have a great summer.